Vwap stands for volume-weighted average price. It's not just the average price of a stock, it's the volume-weighted average, which means it accounts for how much was actually traded at each level. The formula looks like this. Vwap equals price times volume, divided by total volume. Institutions use Vwap to quietly buy or sell large amounts of stock. They break big orders into small chunks and track Vwap to avoid moving the market. If they buy below Vwap, that's seen as a win. Above Vwap, they probably overpaid. That's why Vwap is also a performance benchmark. It tells you if your entry was better or worse than average. Vwap also helps you judge market bias. If price is above Vwap, bulls are likely in control. If price is below Vwap, sellers have the edge. It's a real-time sentiment gauge used by pros. Here are 3 powerful ways to trade with Vwap. First, the Vwap bounce. When price pulls back and bounces off Vwap, it often confirms trend continuation. Second, mean reversion. If price stretches too far from Vwap midday, look for a return to the mean. And third, Vwap breakouts. A breakout through Vwap with volume can signal the start of a new momentum move.